with a summary of what I saw happening this week in the stock market. It's been a soft couple of weeks here.
Yep.
Yeah. I mean, so what has it been? 4 weeks since we started talking about really the consolidation phase that we felt that was going to happen, mainly because we just had such a huge run up in a short period of time without any real consolidation. And really, I kind of outlined that here. So, there's a last consolidation phase and kind of the one that we're in now, as far as that goes. I would not be surprised for this one to kind of extend down to this 4,300 level, right where that other downturn kind of bottomed out. Probably should be some support there. If you look at the previous consolidation zone, it lasted a while, like 6 weeks. And so here we are in the summer. August is generally normally a kind of a soft time for the market. A lot of the money managers are out vacationing and what have you, and such too. So, we'll see how this plays out this year as far as that goes. But nothing to be concerned about here. Matter of fact, as far as I'm concerned, when we look at the market as a whole, these little consolidation periods are critical. For me, what I see is if a market goes straight up, like it did in '99 and, the end of the 2000, it was so fast and so narrow. Sometimes the stretch gets so high to the upside that you kind of get this pullback that comes down really fast and scares people. And then you get this momentum, and all of a sudden you end up with a big downturn that might not have happened if you didn't have the big upturn. And so these kind of small stretch, take a break, another stretch, take a break. This is a very healthy market. And so it's doing exactly what it should be doing. Now, the thing that always amazes me is how the news gets attached, because essentially if you look really closely, almost every day there's some portion of news where it was negative for the market and something that was positive for the market. If it's a down day, we hear about the negative news, right? And if it's an up day, we hear about the positive news. But this news is existing, and really it has not so much to do with what's happening day to day, although that can have an impact. It's really just kind of that supply and demand, right? And so when you have so many buyers that have already come in and stretched that market upward, you kind of get this scenario where, they're exhausted. And now you kind of have more sellers that are sitting there. It could be the same number of sellers, but on a relative basis, the buyers have stopped. And so it kind of comes back down, gets to a level, maybe that green line there at 4,300, where people say, wow, I really wish I would have bought it back then. And it gets there again, and they start to buy again. And so
people look for the deal.
Yeah, and things are on sale compared to where they were. And, hey, I wish I would have bought XYZ stock at that level, and now it's back there again, and I'm going to buy some. And that could be professional money managers or what have you. So the big news this week is just some of the inflation reports that have come out. Let me switch up views here so we can see this a little bit better. There we go. Okay, so this is the consumer price index, what they call the headline inflation number, which just means it includes everything in the basket. And you can see on a year-over-year basis, so this July versus last July actually went up a little bit. We're at 3.2%, and we were at around 3% last month. And so, some concern there. But I'll show you why I'm not concerned about this at this point, because that actually has more to do with what was going on last July than what's happening this July. Core consumer price index, CPI, year over year is at 4.7%, and it's actually down for the month, right? So core just means we took out food and energy, right? That's important. As far as the Federal Reserve goes, they look at core inflation more. It's why we keep talking about it, because really with inflation, there's two different ways to look at it. One, as a consumer, right? As a consumer, we just want things to be less cost. However, there is a limit to that. We don't want, for the market itself, if we get into a deflationary environment where costs are coming down dramatically, that's actually a bad thing for business. Very difficult, because whatever they produce now, they can't make as much on because it's selling for less. And so deflationary environment is actually worse. But we're trying to get this back down, okay? So CPI is not the key measure that the Federal Reserve looks at. They look at PCE, personal consumption expenditure. That comes out at the end of this month for July. But here's core CPI month over month change. So in this case, we're looking at this June to this July. And so it's hard to see that, but it's exactly the same as it was last month. So from May to June and from June to July, it's at 0.16% a month.
Which is great because, if you put that for a year, that's just a little bit above 2.
Actually, it's 1.94%.
Oh.
But exactly. So again, they're looking to trying to get PCI down to 2%, PCE, sorry, down to 2%, not CPI. But this is already at 2% if we keep going at this level, right? So that's really important to understand. Now, annualizing out 2 months worth of data might be a little bit of a stretch, right?
Yeah.
Lots of things can happen, but that is the best 2 months we've had if you look back till that last couple of years. So that's good. And actually, the market responded positively to this when this came out, and I think so. Rightfully so. I mean, it was up almost 1%, and then by the end of the day, we were down to zero.
Yeah, and a lot of the actual increase was from shelter.
Yes.
Which was 0.4 month over month.
Yeah,
so
exactly.
that was like a big bulk of it, and a lot saw that people saw that as positive.
Yeah, and actually partly because the way that they calculate shelter in CPI is very unusual.
It's lagging.
It's lagging for sure. And matter of fact, that's the big criticism of, and what do they call it, super core now,
Yeah.
where they take out shelter because it's just it's a wacky number. They actually assign owner's equivalent rent. So even if you're not renting, they basically try to guess how much it would cost to rent your house.
Yeah.
There's a whole bunch of other details in that aspect that are really kind of fascinating, but nonetheless, CPI I thought was really good. And then today we got the PPI number, the Producers Price Index, and so this is the wholesale prices. Yeah, and so look at wholesale prices; they actually jumped quite a bit year over year, 0.8%. It was almost at zero, and so market responded negatively to this morning. But to me, I look at that and say 0.8% over a year. That's way below the 2%, and so it's bound to bounce back up. And it was a big bounce, but it's too low as far as I'm concerned. If we look at core is actually, when we take out food and energy, wholesale inflation is down to 2.3% year over year, and that's actually down for the month. So I think that's good. And if we look at though month over month change, it's at 0.3. And again, if you annualize that out, that's 3.6%. So that's what the market's reacting to. However, to me, that 0.3 has a lot to do with last month, which was actually deflationary. It was down. So I think this is just a little bounce back. I would not be surprised to see this measure back out again down to that kind of 0.2 range or what have you next month. These are all a little bit volatile, especially month to month, but the market kind of responded to that, right? So that's what's happening as a whole in the inflationary environment. And again, one of the things that's really important to understand about inflation, at least in my opinion at this point, is really what's driving the market. Because when the Federal Reserve is raising rates, the stock and bond market has a really, really hard time doing well, right? And when the Federal Reserve is not raising rates, the market can do fairly well. And when the Federal Reserve is lowering rates, the market can really go, right? I mean, everybody asks me about, well, what's going to happen with the new presidential election or what? The Federal Reserve Chairman and the Federal Reserve Board are much more important to understand if you're going to understand investing. Now, the president does get to pick some of these people, and so Chairman Powell actually was chosen by Trump administration, and then was kept on, throughout the time frame. There's other board members that vote and what have you, and so there is some impact there. But so if we look at kind of that aspect of it, you can see something different here, which I think is interesting. And so the market basically has a futures mechanism to basically have probabilities for what the Federal Reserve is going to do in the future. And this is called the CME, Fed Watch tool. Now, the Fed keeps talking about the possibility of another rate increase this year. And they come out and, they have a vested interest to come out and say they're going to raise rates, even if they're not, because it does potentially slow down the market. Because one of the things that creates a higher inflationary environment is more money. And so if everybody feels richer because the market's doing well, then that can have an impact. 88.5% chance right now that the rates stay the same. So it's 5.25 to 5.5 is where we're at now in the September meeting. And this is after the CPI and PPI reports, all of this. So again, if you really want to understand what's happening here and have some confidence in what might happen in terms of the market, it looks like the Federal Reserve won't be raising rates here anytime soon. Because if you go forward, November, 3.8% chance that it stays the same. And then December, 59.8% chance that it stays the same. Actually, a very small 8% chance that they drop it. But So that's different than what the Federal Reserve's talking about.
Yeah, and the thing with inflation that we have to remember is you don't want it to be dropping too dramatically because that means you're heading for a recession.
Yeah.
So you kind of want this slow descent down.
Yeah, exactly. The curve that we're seeing on top line inflation is a really good curve
Yeah.
to me, and within the CPI and actually the PPI top line pretty much the same. And so, yeah, the shape of that where it's kind of peaked out, last June, July, and then it's kind of come down pretty consistently. I think the Federal Reserve can say to themselves, hey, this is the time we can wait and see what happens. We've raised rates a lot. There's a slow impact to when those rates actually hit the economy. So, anywhere from 3 to 18 months, depending on what part of the economy and who you're talking to. And so, let's see how this plays out. There is this fear within the Federal Reserve, and they've mentioned it several times, at least Jay Powell has, of a reinflationary situation like they had in the late 70s. And so they kind of backed off. They allowed, interest rates to kind of settle in, and they actually lowered rates a little bit because the job market was getting a little softer. And we are seeing some softness in the job market a little bit. We're seeing some higher first-time unemployment claims for the last few weeks. Nothing substantial, but higher. So, and then all of a sudden in the late 70s, inflation got out of control, and they came in and they got here we are at 5.25 to 5.5. They got the Fed funds rate up to 19%.
Yep.
Which honestly, I can't even get my head around. I believe in somewhere in there, they had a 3% increase at one meeting or something really crazy. Because how do you get to 19? You can't do it at a quarter point at a time. It takes too long. So they were trying to really just knock it down. It worked. This was Volcker, and this is kind of the model that they look at now. But that would be, very difficult to deal with. So I do consider that as one of the things we really want to keep watching is this inflationary environment. And I'm very pleased that the market in these futures, reports have been more accurate than the Fed at predicting where rates are going to go. And so watch these, and you get some kind of an idea of where things are going. And so, the rest of this year, things are looking pretty well. Most of the analysts have taken recession projections off the table for 2024. I mean, how many months is 4.5 months left or something, right? So that's an easy call for me. But yeah.
Yeah, and also the Fed's kind of forced to take a break for the next month too, because they're going to have their Jackson Hole meeting instead of an actual regular meeting.
Yeah, and matter of fact, they don't have an October meeting either. If you saw that, we got the September meeting, and then we got November 1st and the December, I think, 13th or 12th. And so that there's only 3 more meetings. I'd say that, unless something really strange happens here, I don't see them raising rates for the rest of this year either. And the only thing that can really move inflation fast is energy price spikes, right? Yeah. That was one of the things that happened in the 70s. And that's something the Fed worries about too, because they don't feel like they can really control, the cost of oil. Something happens in the Mideast or Ukraine situation or something, and all of a sudden oil goes to $200 a barrel or what have you. And that was the fear during this. They can't really control that. They can try to tamp down demand in general, but the problem is that oil and gas goes through every part of the economy.
Yeah.
Your food, it's not just the gas station that you're paying more, it's everybody's paying more for that gas and diesel, and it all ends up being part of the product costs. They go to Target, they're having to deliver that stuff into that store, and so transportation costs can go up a lot, and that gets passed along in some of those. You can buy, a piece of clothing at some store and have a higher cost because
there's some fear with the OPEC cuts and the continued production halting. Right. That there'll be an increase in energy costs.
Yeah, and I'm surprised that it is as low as it is, to be honest, because we're in the middle of a pretty good resurgence. I would say the one kind of outlining thing that's happening here is China's one of the biggest consumers of energy because they produce so much. And we just got a report this week about their exports being, way below expectations. They're actually experiencing deflation, which is not a good situation. But the advantage to the global community at the moment, if there is one, is that if the second largest economy in the world was hot and really going, that would be a real big push on oil and a big push on a lot of other things. And so our inflation here and around the rest of the world is probably somewhat moderated because China hasn't really caught on. And that could be a good thing. So theoretically, ours kind of slows down, our economy maybe slows down enough to let everything go, and not just here, Europe, around the world. And then China finally does get going. That could kind of keep us into that, soft landing zone, right? In theory, because it has been one of my fears that China gets hot along with everything else, but it hasn't happened yet. So it's not. I think that's good for the market at the moment, up to a point. So we'll see how that goes. But
So, what are our signals for the week?
yeah, what are signals for the week? We have some changes on the bond portion, but we're still at yellow on our fast signal for the stock market for obvious reasons. You can see, when you head into these consolidation zones, the markets come down a bit, and so a little caution is advised. New money coming in right now. We're sitting on it. We're waiting.
Yeah.
And just make sure that this consolidation zone isn't a new downturn. And probably, you fall through that 4,300 barrier, we might be heading for a newer downturn because we're starting to set some new lows, and lows are, subjective as to which one should really count. But nonetheless, there's a little bit of caution as far as that goes. But long term, the slower signals certainly still up. But if we look at the bond market signals, those are both red at the moment, right? And it flashed yellow yesterday, came back to red today. And so this is interesting because this should be more on the green-yellow side, because the stock market is, and the bond market tends to do similar things. The Federal Reserve is cutting back on rates, right? We should be seeing better scenarios on the pricing of bonds. But the bond market does have one unique thing going on right now, and that is that they're having to issue an awful lot of treasuries, right? And so the market is absorbing. It's actually going pretty well.
Yeah.
Altogether, I think better than expected, but we're having a massive amount of new issuance of bonds just because the government has to catch up from that period of time they were using extraordinary measures. We hit the debt ceiling in February and couldn't issue bonds, and now we're having to kind of pay all that back for that period of time because they were borrowing money from pensions and different extraordinary measure areas that need to be replenished, and so they're slowly but surely issuing kind of more bonds. We talked about that last week too. So nonetheless, that's what's going on this week. Really appreciate everybody kind of watching, the summary here. Look forward to being able to talk to you again. However, we will not be here next week. I'm actually going to be out of town. So we'll be here in 2 weeks to cover another summary as far as that goes. So thank you.